Hi guys, my name is Alexander Sheffalo. I'm a risk and ops analyst here at Eightcap, and today I'm going to give you my bi-monthly gold report. First, I'm going to cover some of the current fundamental macro and microeconomic factors you must consider when trading gold, and afterwards I will get into the technicals and discuss gold's current price trends during its 2000 to 2010 price range today in the late afternoon European session this Thursday, April 20th. Okay, so the major factors to consider this week for gold are the following. Number one, modest US dollar weakness lends support to gold price. The US Treasury bond yields extend the overnight pullback from nearly 1 month high and exert some downward pressure on the US dollar. This in turn is seen as a key factor lending some support to the US dollar denominated gold price. Apart from this, a fresh wave of global risk aversion traders further benefits the safe haven precious metal. That said, the prospects for further policy tightening by the Federal Reserve act as a tailwind for the U.S. and cap the upside for the non-yielding gold. Number two, bets for more Federal Reserve rate hikes, cap gains for XAUUSD. In fact, the market seems convinced that the Fed will continue raising interest rates to combat high inflation and have fully priced in 25 basis points liftoff in May. Moreover, the Fed funds futures indicate a small chance of another rate hike at the June Federal Open Market Committee meeting, and the bets were reaffirmed by the recent hawkish comments by Fed officials. New York Fed President John Williams said on Wednesday that inflation is still at problematic levels and the U.S. central bank will act to lower it. Furthermore, the Fed's Beige Book showed that inflation in the United States continued to run relatively high. Adding to this, the incoming U.S. macro data pointed to a resilient economy and further fueled concerns that the Fed may have more work to do to contain inflation amid easing fears of a full-blown banking crisis. This should help limit the downside for the U.S. Treasury bond yields and attract further USD buying at lower levels, suggesting that the path of least resistance for the gold price remains to the downside. Next, traders will eye U.S. macro data for short-term policy opportunities. Featuring the release of the unusual weekly initial jobless claim, the Philly Fed Manufacturing Index, and existing home sales data later during the early North American session. This, along with the speeches by influential FOMC members and U.S. bond yields and the broader risk sentiment, will drive the USD demand and provide some impetus for gold price. Traders will further take cues from the broader risk sentiment to grab short-term opportunities around the metal. So slight overview, gold price portrays a kind of a corrective rebound ahead of the key U.S. data events while pairing the losses marked in the last 2 weeks. Even so, gold stays within a 1-month-old bullish channel, as you can see here on the chart, currently between 1970 and the 2050 range top here. As traders kind of remain cautious before the all-important May FOMC monetary policy meeting. Even so, the gold sellers remain hopeful as the major central bankers' higher for longer slogan joins recession woes below the 2010 key resistance. That said, the looming fears of economic recession backed by the hawkish signals from the major central banks seem to weigh on the gold price despite the latest corrective bounce off of the aforementioned channel's lower line. It's actually bounced off a couple times here. Adding to the strength of the rebound is the recent pullback in the yields in the US dollar amid hopes of China's sustained economic recovery. It's worth noting that the incoming figures of the US preliminary PMIs for April and the last round of the Fed's policymakers' speeches before the May FOMC needs to defend the hawkish Fed bets to keep the gold price down for the second consecutive week. Kind of more looking at this technical outlook here from a technical perspective, and as I zoom in here on the 1-hour chart, as you can see, a couple of bounces off this lower channel here, adding to the strength of it. Broke through here, and also this 1980 key price mark but then gathered some strength and returned to this channel, which we have seen in the last month, I say. Yeah, so this from this technical perspective, the overnight breakdown through the 1980 horizontal support was seen as a fresh trigger for bearish traders. That said, the lack of following through and selling and the subsequent recovery here, and we'll probably zoom in a little bit more here. Yeah, so the lack of follow through selling and subsequent recovery warrants caution before positioning for any further depreciating move or on the downside. Meanwhile, any further move up might now confront resistance around the 2012 to 2015 zone, which we've already seen a little bit today as it touched about 2011, 2012 earlier in this morning, or I guess this afternoon. So a sustained strength beyond might trigger a fresh bout of short covering and lift gold price beyond the 2020 intermediate hurdle towards the 2040 horizontal resistance en route to the year-to-date peak around the 2047 to 2049 region. On the flip side, the 1980 area, followed by the overnight swing low around the 1969 area right down below here, region now seems to act as immediate support. Obviously, it's a little bit lower than this drawn channel here. But given that the oscillators on the daily chart have just started drifting to negative territory, some follow through selling should pave the way for an extension of the recent retracement side from a one-year high. The gold price might then slide towards testing the next relevant support near the 1956 region to 55 region before eventually dropping to the monthly low around 1950. So kind of an overview on the key levels to watch here is the daily high today has been around 2012, 2011, previous day low, 1969, pretty low, a lot of volatility in the last couple of days. The previous week low was 1986. Previous week high was 2048. Previous month high was 2009. Previous month low was 1800, as you can see, 1809, as you can see all the way down here. If we keep zooming out, there we go. And so, kind of taking a step back from everything, overall, gold price grinds higher towards the 2010 resistance confluence, comprising the previous monthly high and a Fibonacci 61.8% on the 1 week. Ahead of that, a convergence of the 10 DMA and 5 DMA prods the gold bulls around 2008. It's worth noting that the gold price upside past 2010 is a minor bump around 2015, encompassing pivot point on the 1-day R1, which can prod the XAUUSD bulls before directing them to 2050 resistance that includes a top of line 1-month-old bullish channel. On the contrary, the Fibonacci 61.8% on 1 day and the middle band of the Bollinger on the 1 day together highlight a 1995 and has immediate support for gold traders to watch during the quote fresh downside. Following that, the previous week low around 1985 and the pivot point of 1 week S1 around 1977 could act as the last defenses of the gold buyers. Overall, the gold price remains on the bears' radar unless breaking 210. That's all from me this week. Thank you guys for staying tuned, and I will be back again in 2 weeks' time. Thank you.